what you have to do when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order, and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to exchange, to take your gold and gold under the, in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is $4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America, and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint, I would be less worried about, because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, the regulator, through regulation, if you like. There may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation, and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship, usually, with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral, or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights. The fact of the matter is that there was an explosion of borrowing, debt in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so they could resume trading once COVID was done. And as well as governments, you look at governments, the government debt in the US doubled between the end of 2019 and today. I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt. And it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE, and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get is you're going to get businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? There are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge, great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates and all the rest, higher interest rates. They're not, they're losing their jobs. They're not getting the pay rises, whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating. And even though a lot of government statistics have been shut down because of, the debt ceiling, I really do think that, there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government. But that's reflected in a loss of purchasing power for the currency, which is why you have gold. And which is why, when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.
When people ask me, Alasdair, where should I store my gold? I often say, that's the wrong question. The real question is, where can you safely store your trust? Because that's what it comes down to. You're not just choosing a vault, you're choosing a legal system, a jurisdiction, and a set of property rights that may or may not be respected when the next financial storm hits. It's a question not about metal, but about sovereignty, about who really owns what when things go bad. Let's take America, for instance. Now, I know many of you watching may have your gold in American vaults or ETFs, and I understand why. It feels convenient, it's close to home, and you tell yourself, surely, this is the safest country in the world for property rights. But history would beg to differ. People often bring up 1933 as the Great Gold Confiscation. But that's not technically what it was. It was a forced conversion. Citizens were ordered to hand over their gold to the banks at $20.67 per ounce. And in return, they received dollars. Not theft, they said, monetary policy. Of course, once the gold was safely in government hands, the official price was revalued to $35 per ounce, effectively stealing 70% of purchasing power from anyone who complied. Those who didn't, who quietly kept their coins tucked away, well, they simply kept quiet and carried on. It wasn't that men in black suits knocked on every door demanding your Krugerrands. It was that the banks, being obedient arms of the government, obeyed the order. So if you had your metal inside the system, you lost it. If you had it in your own possession, you didn't. The lesson is painfully simple. Once your wealth is inside their system, it's not really yours. Now fast forward to today. There's still an official gold exchange rate in the United States, $42.22 per ounce, a relic from the 1970s that still technically exists on the Treasury's books. Imagine a future financial emergency where the government decides, you know what? We need to stabilize the dollar again. Let's make gold redemption mandatory. At $42.22, you'd be forced to exchange something worth $4,100 or more on the open market for $42 a pop. It sounds absurd, but so did 1933 before it happened. And the legal mechanisms to do it again still exist. Would they really force that on American citizens again? Possibly not, at least not directly. But could they pressure the banks, the vaults, the ETFs, all of which are American corporations, to temporarily assist in stabilizing the financial system? Absolutely. That's why I tell people, don't store your gold in America and don't store it with a company that's legally based there. The risk isn't about burglary or fraud, it's about jurisdiction. If you must store metal outside your own home, choose a place where property rights are deeply ingrained, where the government can't just wave an executive order and seize assets by decree. Countries like Switzerland, the United Kingdom, or even Canada, despite its flaws, still maintain relatively strong property protections. The Royal Canadian Mint, for instance, operates under a legal structure that makes outright confiscation far less likely. And Switzerland, love it or hate it, still holds to that old-world respect for ownership and privacy that's been disappearing everywhere else. But whatever you do, don't confuse ETFs with ownership. That's the biggest trap of all. When you buy shares in a gold or silver ETF, you're not buying metal, you're buying exposure to price. You don't own a single bar sitting in a vault. You own a piece of paper that says the fund owes you a share of whatever assets it claims to have. You have credit, not possession. And here's where it gets even messier. The ETF doesn't even know who you are. Its official shareholder is almost always an intermediary, like the DTCC or Euroclear, massive clearing institutions that hold assets on behalf of brokers, who in turn hold them on behalf of you. So there's at least 3 layers of separation between you and your supposed gold. And guess what? Those intermediaries are legally entitled to use your ETF shares as collateral in a crisis. That's right. They can pledge, lend, or even liquidate them if it serves the system's stability. You'll still own them in theory, of course. You'll get a polite note saying your assets are safe, but they'll be temporarily rehypothecated for the greater good.
You'll get killed. It's as simple as that. Because they're far cleverer people than you with big, deep pockets who will push things around. And, if they reckon you're in there, they'll kill you. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that, because they are at a premium price, is because they are money. They are legal money. They are final settlement without counterparty, counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters, and that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. That tells you basically that a 1971 dollar, or rather the dollar today, is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies. That's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. They've been educated, I think, by the macroeconomic establishment, which really started with John Maynard Keynes, to, if you like, use a weak currency to benefit the economy, to stimulate the economy. They're not going to change for that, particularly when freed from the constraints of a gold standard, that they can issue as much debt as they want. And doing. So you've got an accumulation of debt, and that's where the crisis now is. What's going to happen to the value of that debt? The other side of that debt is the value of the currency. Debt equals credit. Credit is the currency, and also loans underneath that, which businesses have taken out, individuals have taken out, stock market speculators have taken out. It's the value of that credit, which you've got to question. You've got to keep your eye on that. So short answer to your question is that stackers should maybe say, well, thank goodness we've got a sort of situation which means I can, save a bit more out of useless credit and put it into real money. Let's hope this pause goes on for some time. And then I can really sort myself out. I think that's the way to look at it. Not to be spooked by what's going on, if you like, in up 5%, down 5%, whatever. You can see lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price.
Now let's talk about the next chapter of this unfolding story. Because make no mistake, what we're living through isn't random chaos. It's the predictable endgame of 50 years of monetary malpractice. The U.S. government, as it stands, is insolvent in everything but name. Its debt is growing faster than its GDP, and the interest on that debt now exceeds defense spending. Think about that. America now spends more servicing old debt than it does defending itself. That's not strength, that's terminal decline. And the only way to keep the illusion going is to print more dollars, which of course devalues every dollar in your pocket. The irony is that this debasement masquerades as prosperity. Stocks go up, property prices rise, GDP looks inflated, literally, but none of it reflects real wealth. It's nominal illusion, and the people who sense that illusion are quietly shifting into real money. That's why gold's rally isn't just a hedge against inflation, it's a vote of no confidence in the global financial order. When gold hit $4,000 and silver started breaking resistance levels, it wasn't because traders were euphoric. It was because the market was losing faith. Each rate cut from the Fed accelerates the process. They cut in July, gold jumps. They cut again in September. Gold surges further. It's not correlation, it's cause and effect. And silver, as always, lags until it doesn't. When gold breaks new ground, silver wakes up like a startled bear and charges forward. We're not far from that moment. Now in the short term, sure, we'll see volatility. The powers that be will do everything they can to shake out weak hands, dumping futures contracts in the thin hours of the night, triggering margin calls, feeding headlines about speculative froth. But those tactics are wearing thin, because behind the paper market lies a physical one that's stretched to breaking. Lease rates soaring to 100%, backwardation persisting, ETFs halting share creation. These aren't signs of stability. They're signs of a shortage so severe that the illusion of abundance can't be maintained much longer. Remember, the futures price doesn't set the real price. It distorts it. When the paper market finally fails to deliver physical metal, the entire pricing mechanism will implode. That's when the reset begins. The question then becomes, how does one prepare? And this is where I'll give you advice that might sound simple but has saved countless fortunes through history. Own the metal, not the promise. Have direct title, ideally outside the banking system, in a jurisdiction that respects ownership. If you can't touch it, you don't own it. As for where to hold it, that depends on your personal situation. Switzerland remains a strong option, though even there, pressure from global regulators is rising. The UK and Canada still offer reasonable legal protection, though I'd avoid any vault linked to US corporations. Singapore and New Zealand are also emerging as secure, independent jurisdictions for physical storage. But wherever you choose, make sure the contract is crystal clear. Your metal is held in your name, not as part of a pooled account. And yes, home storage is still valid, as long as you're prudent. A small safe, well hidden, and known to as few people as possible, can protect a portion of your wealth better than any vault ever will. Remember, governments can seize what's in their system, not what's under your floorboards. Now some will say, but Alasdair, aren't you being a bit alarmist? I wish I were, but the evidence is overwhelming. The American debt explosion alone tells a story. In 2019, $23.6 trillion. Today, over $47 trillion. That's a doubling in 5 years with no end in sight. You can't double debt without doubling interest payments, and those payments are now the fastest growing line item in the federal budget. Even if the Fed wanted to normalize rates, it can't. The moment it does, the government itself defaults. So what's the solution? Devaluation, pure and simple. Inflate the debt away. That's what's happening now, quietly and deliberately. Every time the Fed cuts rates under the pretext of supporting growth, it's actually cutting the value of your savings. They're trading your purchasing power for political time. And that's why gold will keep rising. Every cut, every bailout, every temporary measure will push more people toward tangible wealth, because people are not stupid forever. They eventually see that the emperor has no clothes. And when they do, they run for cover. This brings me to an even deeper issue: the zombification of the real economy. Cheap money created an entire ecosystem of unproductive entities, corporations that can't survive without perpetual refinancing. When rates rose, those zombies began to die. The casualties started with speculative tech firms, then spread to real estate, and now they're hitting consumer credit. The wave will continue until the Fed intervenes again. And that intervention will mark the death of the dollar's credibility. We've seen this movie before. Every fiat currency in history has eventually failed. The timeline varies, but the ending is always the same. Debt expands, confidence collapses, real assets surge, and paper dies. We're simply in the final act now. And yet most people are unprepared. They trust the system because it's all they've ever known. They think 401ks, ETFs, and index funds are safety nets, not realizing they're woven from the same paper the system is printing into oblivion. They think property rights are absolute, not realizing that in a crisis, governments rewrite laws faster than markets crash. So what should you do? You prepare quietly, patiently, without fanfare. You move a portion of your wealth into physical gold and silver. You store it wisely. You keep cash for emergencies, but not too much. You reduce debt wherever possible, and you ignore the noise. Because when this all unwinds, it will happen fast. Too fast for most people to react. I can't tell you exactly when the dollar's final decline begins, but I can tell you this: every rate cut brings it closer. Every deficit widens the crack. Every bailout erodes the trust. And when trust goes, everything built on it goes too. The transition won't be smooth. There will be chaos, controls, new currencies, perhaps even a digital dollar sold as innovation. Don't be fooled. A central bank digital currency is just the old fiat system with tighter chains. It's surveillance, not salvation. The real freedom, the real safety, will remain in assets that exist outside that digital grid. That's why when the dust settles, gold and silver will not just be expensive, they'll be priceless. They'll represent independence in a world that's forgotten what that means. So hold your mettle, hold your nerve, and remember, this isn't about getting rich, it's about staying free.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.